and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, please be sure to hit the follow button on whatever streaming platform you're listening with, or by following at QC Weekly Comment on LinkedIn. I'm your host, Andrew Jones. I'm an investment manager based in the London office. And this week I'm joined, as ever, by Richard Carter. I'm pleased to be joined by Ben Barringer, head of technology and telecommunications, and generally a tech guru. So good morning to you both. I'm going to start again, as always, with you, Richard. And I want to keep this fairly quick. I mean, we've been talking about what's been going on in the Gulf, the operation, whatever it was called, for quite a while now. So I don't think we need to dwell on that too much. I don't know if you have any particular macro observations around that, or whether you want to talk a little bit about the upcoming rate hikes, which is the main thing I think that's coming out of that at the moment, that we're expecting ECB to hike in June and 50 basis points for hikes before the end of the year for the Bank of England, which is entirely driven by what seems to me by the increased oil prices. So your thoughts, Richard?
Yeah, Epic Fury is the operation.
That's it.
Although Epic Shambles might be a better better name. I mean, obviously there's a lot of back and forth. Trump seems to be negotiating with the Iranian sort of in his head rather than actual reality. But clearly we don't seem to be any closer to the Straits of Hormuz being open, which is bad news for the global economy, bad news for the inflation as well, and we need to see that change. I mean. Yeah, there were we had central bank meetings last week. I mean, not surprisingly, nobody sort of did anything dramatic. Everyone's kind of in wait and see mode, a bit like we are in some regard. And there was not much chance of the Bank of England raising rates last week. And it wasn't actually, the vote wasn't even close in the end. You know, there was 8-1 in favour of a hold. But yeah, like you say, markets are worried that this is going to carry on for a few more months. It's a big inflation shock, and there are hikes very much built in to the UK and European yield curves. I mean, the gilt market's expecting a 50-50 kind of chance of rate hike in June and 325 basis point hikes this year. Now, let's be honest, the economy doesn't want that. It's not strong enough really to be seeing rates go up, but they're very worried, obviously, about the inflationary impact. And the longer the conflict goes on, the more chances they'll have to pull the trigger.
Yeah, no, absolutely. I think the thing is, things just change from day to day, yet stay spookily the same. So we're going to have to watch and wait on that one. I'm happy to skip forward, really, and thanks for reminding me of Operation Epic Shambles, because that rather segues rather neatly to the main thing I wanted to talk to you about, which is the UK political situation. And I'm a bit concerned, actually speaking for myself rather than for Quilter Cheviot, you understand. I'm a little bit concerned that the gilt market hasn't fully priced in the delights that would await us if we ended up with either the King of the North or Angela Rayner as Prime Minister, propped up by the ever reliable and pragmatic Mr. Miliband as Chancellor, which I've seen quoted, and I've sort of gamed that through my head and thought, well, I can actually see how that would happen. And that seems pretty scary. And I think the one pragmatist amongst all of that, Wes Streeting, is a non-starter because he doesn't have a strong enough majority in his home seat, and he would be leading into an extremely fragile situation come the next election. So do you think the gilt market is so distracted by what's happening with oil prices that it doesn't see this looming horror, or am I, as I often do, exaggerating on the downside?
It definitely sees it as a danger. I mean, by King of the North, I presume you mean Andy Burnham. I don't quite see what his route to power would be in the short time frame. I mean, obviously we've got local elections this week. If they go horribly wrong, and
I'm going to stop your flow right there, Richard. Sorry, his route to power. Apparently, 4 Labour MPs now have put their hand up to say they would step down to allow him to come back into government, with being short-circuited into number 10 sharpish. So I think that's that's his route in. So I'll shut up now.
It could happen. I suppose it could happen. I mean, it would take a bit of time to get through the local elections, and maybe by then, and get the by-election done. Maybe by then, his rivals might have moved ahead of him. But certainly there is a risk of a leftward shift. We haven't seen. I mean, none of Starmer's main rivals kind of put the knife in over the Mandelson issue. Maybe they are waiting to get local elections out of the way, and then they will see. But they seem to be a bit more reluctant to actually sort of go and resign or do whatever, or go and stand up and say, okay, it's time for a change. So maybe Starmer will cling on for a little bit. But coming back to the gilt market, it's very hard to sort of disaggregate what's being priced in terms of inflation and oil prices and all the rest of it, and then political risk. I mean, there's not been any great move in sterling, no adverse moves in sterling, which you would expect, when we had Liz Truss and all that, we saw some big moves in sterling. If you look at UK CDS, which are a bit of a sort of strange corner of the market, but they've not budged. But the gilt market has underperformed other bond markets, similar bond markets like Germany, US, maybe some of the European ones. That might partly because we're more exposed to oil prices and energy prices. It might also be because the UK gilt market was seen as a bit of a establishment kind of consensus long going into the war, because actually inflation was coming down, rates were coming down, it was a good position to be, and that's now suddenly reversed. I think there is an element of it being priced in, but not fully, and I think there is still a sort of hope that, or whether it's hope is the right word, but there is an expectation that Starmer will cling on. One thing I would say about the whole situation in the UK, and I was at a conference a couple of weeks ago, Gordon Brown was there and sort of talking about it. Whoever comes in is going to face the same fiscal problem that the current government and the last government have faced. And if you don't have the credibility and you don't retain the confidence of markets, you are going to be stopped from doing what you want to do economically very, very quickly. They cannot afford, with the UK's fiscal position, to get the gilt market so offside that borrowing costs go through the roof. So I think whatever will happen, even if it's Angela Rayner, they'll very quickly have to come out and say, we're going to operate within the fiscal rules and all the rest of it. I could be wrong on that, but I do not think they have much room for manoeuvre.
Naturally, I completely agree with you. With taxes at all-time highs and gilt yields where they are, and so on, I think you're absolutely right. I think it'll be extremely uncomfortable if either of the two people I suggested end up in the hot seat, because Andy Burnham has already said that he doesn't think we should be beholden to the gilt market, and I think it would be interesting to have someone explain to him quite why we're beholden to the gilt market. But that isn't a lesson they're going to want to hear.
They'll learn it after they're in the post. They don't want to say it beforehand because they want easy. Like there's a lot of politicians in this country. They want to give easy answers to complex problems, but once they're actually in power, they don't have a choice.
I love an easy answer to a complex problem, to be honest. I'm all ears for that. Thanks for that, Richard. I'm going to pass over to Ben. I'll pass over to Ben now because I've got quite a few things I want to ask him. Ben, easy answers to complex problems. You are the man I would come to for that every time. And thank you for stepping away from your busy schedule with CNBC and Bloomberg and everybody else. I know you had a really busy back end of last week in terms of results coming thick and fast, and I know that keeps you up to the early hours of the morning, given the fact that your results are coming from America. From what I can see, Apple and Alphabet came up with some pretty good results. Microsoft were pretty so-so, but the share price was been pretty solid. Meta's taken a bit of a tumble. I wonder if you could recap for me and for our long-suffering listeners, really your experiences of the reporting season.
Yeah, thanks very much, Andrew. Yeah, you're right. It was early starts, and I think had $12 trillion of market cap in about 24 hours. So very, very busy. So listen, you're dead right to highlight Google on the sort of positive side, strong search growth and their cloud business doing very well, and a very big backlog, basically an order book they've got there. Meta on the other side, actually, I think it was a bit of travel and arrive. They revenues were up 33%. That's the best of all of the big Mag 7 companies, and they upped their capex a little bit, but their guide was a little bit below what people had hoped for, and that even though that guide was still 26%. So Meta, I think, still has to prove its case for its growing capex burden. Microsoft, very strong Azure numbers. That's their cloud business. And their capex, that went up very significantly. So those two things sort of offsetting each other, really. Amazon up 15%, and AWS was pretty good. And then Apple, they're having a very good cycle, actually, in terms of the iPhone 17. Strong demand. There's two impacts, though, that even though they're not investing a lot of capex in AI is having an impact on them. First of all, they couldn't produce as many iPhone 17s because TSMC, who makes the majority of chips in the world, had a restriction caused by Nvidia and AMD and Broadcom and so on producing lots of AI chips. So Apple couldn't actually produce enough, so that they were supply constrained. And then second of all, they're seeing a memory headwind in terms of one of the big inputs into an iPhone is obviously memory. The memory price has been very, very strong over the last year or so, and that's causing them a margin headwind. So either they're going to have to take a hit in the future on their margins, or they're going to put the price of iPhones up. So they provided a decent guide as well. The real focus, though, for the stock market is in terms of capex. So this is AI capex, and as I say, Microsoft increased their capex. That will now be up 80% this year. Google's, they moved it up a little bit, but it's still up. It's still doubling. Meta's is just less than doubling, and Amazon is up about 50%. So in aggregate, capex this year will be up 73%. Obviously, the stock market thinks about the future, not what's happening in 2026. It thinks about 27. And that now looks like over $1 trillion of capex is going to happen in 2027. And that's going to be up around 25 to 35%. So what people are now focusing on is that capex number and that big increase. What's that mean in terms of returns? And it's interesting because you're starting to see in a number of cases accelerating revenue, certainly in terms of cloud revenues are accelerating, but also, some cases where margins are improving as well. So we're not at the stage where we can declare that there are good returns on AI capex, but there are certainly some encouraging signs there. And we're also starting to see very strong, demand for a lot of these services, particularly in things like coding, but increasingly in things like, Microsoft Copilot, which Microsoft called out. So look, overall, the best way at the moment to play that big capex rise is with the semiconductor companies and the hardware companies that are filling these data centers full of chips, be it processors, CPUs, GPUs, and memory. I think I'll leave it there, Andrew.
No, that's perfect. And yes, I'm a big fan of the old picks and shovels argument, which I must admit I've been talking about for 30 years. But it's certainly the picks and shovels which are making some of the money now, but increasingly getting rather unpopular. Capex huge, data centers huge, gobbling up ever increasing amounts of both. Well, okay, America's got lots of space, which we don't happen to have so much of in this country, but gobbling up massive quantities of electricity and seeming to be getting quite unpopular. I saw that the state of Maine in the US actually had a moratorium. Had a moratorium on any further data center development until 2027. Now I know that was vetoed by the state governor, but it shows a real line of travel. And here, I think 27 states in the States at the moment are looking at state level legislation to control, limit, or have a complete moratorium on further data center developments. And that statewide, 2/3 of people in the state seem to oppose data centers, which means data centers have got a worse approval rate than Donald Trump.
Yeah, that's absolutely right. So look, there's a bit of context. We've been talking about cloud and AI growth for over a decade, and certainly been quite positive about this AI cycle because we do think it's a new compute paradigm for the world. Now, with all good investment theses that are playing out, you're constantly looking for things that could be upsetting that thesis. And, maybe we were thinking about memory shortages or chip shortages a few years ago. And maybe a year ago, I was thinking about power shortages. And those, we're reasonably comfortable that the market and the AI industry can find a way. But you're always looking for new pushbacks, and over the last 6 months, probably we've been thinking about political pushback because, as you rightly say, there's been quite a series of state legislation pushing back on AI. Now, could that be data center blocks, not blocking new planning for data centers, not NIMBYism, not in my backyard stuff, or increasing power prices? These data centers take all my power and my power price is going up, which is sometimes true, but not always true. Or the raw data AI is going to take my jobs. So we're watching this very, very closely at a state level. Now, at a federal level, at a Trump level, AI is, Trump is relatively positive on AI. But does that, those issues on a state level, and particularly around the midterms, does that cause some rolling back of the expansion or a restriction on the amounts of AI rollout? So what am I really looking at? So I'm looking at a number of sort of statistics to sort of track this. Productivity, labor capital substitution for all the economists out there. AI employment, what are the job openings and job losses as a result of AI and participation rates and things like that. Obviously, AI adoption, and as I previously talked about, return on investment on that AI. And then, as you rightly point out, AI sentiment surveys and so forth. So there is definitely an issue there, as you were pointing to. What could governments actually do to sort of stem the flow or keep people happy? You talked a little bit about data center moratoriums. Those are possible. Or could they build these data centers elsewhere? It's actually mildly ironic that the Middle East is actually a very good place to build data centers because they have an abundance of space, power, and money. That's, unfortunately, the US has a restriction on the amount of power that it has. Interestingly, China doesn't have the right chips, but it does have an abundance of power. So, lots of ways that we can sort of square this circle. And then potentially a tax on capital. We're all taxed as labor, but as you get a rebalancing of labor capital, could actually AI or AI agents be taxed? So, look, these are all things that we monitor as a potential way of putting a pause on AI. Could there also be, sort of safety guardrails? And I think that's very interesting around what AI we allow AI to do and what we don't allow AI to do. So sort of all things that we watch. No concrete answers for you at the moment, Andrew, but bear in mind, just bear in mind that we've been looking at this before it's become sort of popular in the press, sort of at least 6 months. And so I do continuous calls to make sure that there is still scope for our preferred names to continue to outperform.
I think a lot of the problem with this is that the beneficiaries of AI are seen as being the corporate rich, and those who will suffer from AI are seen as being ordinary people, because as you said, the big scare is that is AI is going to take my job, and the AI jobs bloodbath that we're all expecting. So I think that's something that the AI industry is going to have to address. Not I don't think it's really going to be a choice going forward. What's the benefit to ordinary people? Do you?
Well, yeah, this is. But I mean, we do all. If we users of AI, will recognise the benefit that we have. We have much faster time to speed to answer from our questions. We can learn an awful lot quicker using AI. So there is that benefit. But obviously, with all technological revolutions throughout history, the printing press, the plough, the tractor, there have been concerns that people are going to lose their jobs. Now, the fact of the matter is, in all of those previous, new industries have been created and humans adapt to that technological change. It always feels like it's different this time. I understand that, but that has been the history.
Absolutely, that has always been the history, but I think the industry is going to have some work to do to persuade the ordinary person that all those benefits that you rightly listed of faster search times and so on is actually worth paying for with their own employment prospects. But anyway, so I know you're pushed for time, so I'm going to skip on to my next thing I want to talk to you about, which is also firmly in the scaremongering camp. Anthropic seems to have developed some kind of doomsday machine called Mythos, which is an AI model or engine which is so dangerous that it can only be released to, I think, 20 companies because it will take a wrecking ball to all their software security and so on. I don't know much about this, Ben. Is it as scary as it sounds?
I mean, we don't actually know because we weren't part of Project Glasswing, which was the release of Mythos, as you rightly say, to
I told you that I've already shot you.
number of companies. Because when I talk about AI, and those who have seen me present on AI, I talk about the tasks that we have given AI over time, be that handwriting recognition or translation, language translation, and so on and so forth. Computers have increasingly got better and better. Dictation is a brilliant example. Computers have increasingly got better at those tasks over time. And now we have applied cybersecurity, or more importantly, actually cyber hacking, and Anthropic has let its models have a go at trying to hack big software companies. And it's found some bugs in those in software that that people hadn't known about for, they report, over 20 years. So maybe it's getting better at those tasks. It's going to be good at those tasks as well. Now, again, back to my point around sort of safeguards and guardrails, I think that's going to be super important when we release these models. Now, there are always, again, similar to what I was just saying, in all technological releases, there are points where people are like, well, this technology needs to stop, or there needs to be safety improvements. I would point you, Andrew, to the invention of the motor car, where men had to stand in front of the cars with red flags to advise people and keep people safe. Now, the industry gradually worked, and people's public opinion gradually worked out that you didn't need those people with red flags, and people got used to that particular piece of technology. But safety is going to be an important part of the AI rollout. And I also think brand safety as well. And it's interesting that Anthropic has actually released this model, because I would say that Anthropic's, if you will, brand identity, if there is such a thing with AI models, is for a safer or more trustworthy type of model. And so I think they have to be very careful about how they release these types of models. There are going to be lots of headlines around AI not being safe and it doing silly things. That has always been the case with generative AI since its release 3.5 years ago. But the important thing to remember is that you have to be very selective about what access you give it to data. And you also have to make sure that it learns from any mistakes that it makes, right? And so it's easy to say, to just try and dismiss AI, particularly if it's going to take your job. I think that is an intelligent mistake, because these models will get better at things. And I do think that there are going to be tasks that they're going to be, quite good at, including helping us protect from cyber security as well. It's just important that the good guys get hold of it, not the bad guys. And again, that's a security problem.
Well, absolutely. Fingers crossed for the good guys, certainly. So, look, I mean, the other thing that's coming up, of course, is that Anthropic is due, I believe, an IPO that is IPOing this year. So this is garnering it a great deal of column inches and a lot of excitement around it. So that will probably be beneficial as well. Yes. Before I let you go, I'm going to ask you a very, very quick question. GameStop buying eBay. eBay share price is up. GameStop is down. Is this a good thing or a bad thing? Will it happen? Won't it happen?
This is a little bit out of my wheelhouse.
It's out of your range, I know. So.
No, absolutely. But it's interesting, essay to column inches. So basically what's happening is GameStop, the original meme stock, I think it's probably best to just classify it as, has bid 56 billion for eBay. It's going to be shares and cash. The question really is, and the reason they want to buy it is because they think they can give better revenue using their GameStop 1,600 stores, and they also think they can manage the costs of eBay that much better. The real question for investors, and particularly the board of eBay, is how financially credible this is, because they're going to have to do a very substantial debt raise, essentially. So I think the odds are low that they will be able to buy it, but never say never. It's probable that the board rejects it. But it is interesting because in these situations, you do get these kind of activist involvements in underperforming companies. Not that eBay's been doing that badly, actually. Catalyzes change and gets the current management of eBay to try and think about things a little bit more differently and so forth. So I don't think it's a complete waste of eBay's management's time, but I do think the probability of success is relatively low, I would say.
That's great. Okay, Ben, look, thank you very much indeed for your time this afternoon. I'm going to let you go. Thank you also, Richard, for your insights, as ever, on the macro field. And thank you all all for listening. I hope you enjoyed our podcast today. We actually love to hear from our listeners. So please review the show wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, hit the subscribe button. We'll be back next week. In fact, I'll be back next week as well, because I'm doing this again next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and upcoming events and webinars on our website or on our social media pages. Finally, if you do have any questions you'd like to ask one of our experts for our next podcast, or even me if you don't want to ask one of the experts, please ask them via the weekly comments page on the website, and we would love to hear your questions directly. So that's it for today. Thanks again, Richard. Thanks again, Ben. Thank you for your time today, and thanks all for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.